Welcome to this week's Market Talk. I'm Amber Lancaster, joined today by Ian Dyer and Paul Mampilly. And as you can see, we're coming to you live in living color on video, all three of us together. So welcome, guys. Good morning. It's morning, by the way. Good morning. Glad you're all together. Hi.
Great to see you.
Thank you. Same here. Okay, we're going to get started today with what we're covering. We like to offer our perspectives on the market for each week, and we look forward to sharing our viewpoints with you, our readers. So we're going to be giving you some insights into what's on our radar. And today's outlook is for the week of February 11th, 2019. So I'll begin by sharing what I'm watching, and then we'll hear from Ian and Paul. So first, on Wednesday morning, the January U.S. Consumer Price Index for all urban consumers, month over month, also known as CPI, will be released. In December, CPI, which is the key calculation for inflation, fell 0.1% on a seasonally adjusted basis, as gasoline index declined abruptly. Economists are anticipating a rise of 0.1% for Wednesday's print. Now, keeping with the inflation focus, the release of the U.S. producer import prices on Thursday and Friday, respectively, will help us gauge if inflation remains tame. The Producer Price Index, or PPI's final demand month over month for December, was the largest decline in over 2 years. The big drop showed inflation was under control. Overall, that decline supported sentiment that the Federal Reserve would hold off raising interest rates in the near term. So Thursday's February 14th release will show if the index continues to support this Federal Reserve position. So right now, as I review economist surveys for PPI, it's expected to remain underwater, but by only negative 0.1%. So we'll know the final number Thursday at 8:30 a.m. Eastern Standard Time. The second index I mentioned, import prices, which reflects the cost of goods imported into the United States, will release its reading on Friday, February 15th at 8:30 a.m. This reading will be for the month of January. So import prices in December declined 1%, turning negative year over year. The decline was largely attributed to lower oil prices. And this fall offered another reason for the Federal Reserve to slow down on interest rate hikes. Economists are expecting another decline in import prices for the month of January, albeit not as low. The anticipated print is negative 0.1%. Now, turning to earnings news, earnings releases continue to be active this week. We'll have reports from Coca-Cola, Cisco, PepsiCo, AIG, and Deere & Company. A compromise in congressional talks over the U.S.-Mexico border wall and security will be realized this week to evade a second partial government shutdown. So if no deal is reached by Friday, February 15th, 9 federal departments and related agencies will close. Now, on the artificial intelligence front, according to the Associated Press, President Trump plans to sign an executive order directing federal agencies to prioritize research and development in the field of artificial intelligence. The plan will be called American AI Initiative. Per the Associated Press, one of the key parts of the initiative is to call for federal agencies to help workers acquire pertinent skills through fellowships, apprenticeships, training programs, and computer science education. So once signed, Congress will need to appropriate money for the plan as they see fit. Also in AI, it's being reported in UK's Daily Mail that Amazon's Alexa will be used as a virtual medical coach. This medical coach will monitor patients with high blood pressure, asthma, depression, and diabetes in their own homes. This news is based on a brand new independent report by U.S. cardiologist, geneticist, and digital medicine researcher, Dr. Eric Topol of Scripps Research in California. Dr. Topol's report, titled Preparing the Healthcare Workforce for Delivery of the Digital Future details how smart device speakers like Amazon's Alexa, Microsoft's Cortana, and Apple's Siri are becoming virtual health tools. The report predicts that within the next 20 years, virtual medical coaches working through voice recognition speakers in the home would aid in the management of chronic conditions. The Daily Mail quotes that these programs will use artificial intelligence and deep learning about someone's illness and normal behavior to preempt hospitalization by spotting when something is wrong. So they would connect to maybe a wearable sensor or medical data and even detect stress in someone's voice to tell when their condition was deteriorating, end quote. So AI and deep learning continue to take a major foothold in our everyday lives. So with that, that's what I'm watching so far in the AI news. And lastly, as this chart shows, our disruptification index continues to outpace major indices 2-to-1 year to date. As of Friday's February 8th close, the index is up 15.5% versus 7.6% on the Dow and 8% on the S&P 500. So that's what I'm watching. Ian, tell us what you're watching this week.
That was a very good update, very comprehensive, and I just want to get into kind of what we've been seeing in stocks recently. And as you mentioned, it's earnings season, and we've seen now about 2/3 of the S&P 500 companies have already reported. And so far, the results have been amazing. So about 71% of those companies have reported higher than expected profits, and 62% of them have reported higher than expected sales. So this has really caused a lot of buying in the market. And last week, we saw a lot of 52-week high being made. And specifically on Tuesday, we saw 131 stocks in the United States markets make new highs. And this was one of the highest days in the past 4 months. And it shows that a lot of people are coming back into the market now. And with these great earnings results, we expect that buying to continue. And one of the interesting things that I saw was that the industries that are doing the best so far in 2019 are cyclical industries. So we have things like industrial, semiconductors, real estate, and oil all doing very well in 2019. And they're leading the market. And this shows that people are kind of getting over that fear of the recession that they had last year. As you may have noticed, there's been a significant drop in the amount of articles and things being talked about on the news saying that there's going to be a recession in 2019. People are gaining their confidence back. They're buying into these cyclical industries and pushing stocks way up, which is also great for our portfolios because we tend to invest in growth stocks and things that are going to affect the future rather than quote unquote stable companies that have been around for the last 50 to 70 years. So now that people are buying back into these stocks and cyclical and growth industries, we expect that to really push up the market over the near term. We expect 2019 to continue being a good year. And of course, we don't expect a recession at all this year. And that's all that I have for this week. So Paul?
Hey guys, so that was a great update. So much going on from so many different perspectives, and just to retouch on some of the things that you guys brought up. So interest rates, there was this great fear that the Fed would raise interest rates. And if they had raised interest rates, obviously that would have ended up slowing the markets because they're now lifting the cost of capital. There was also a great fear last year that with the tax reform that happened, and the tariff war, that inflation would shoot higher. And obviously that was a fear that people were pricing in. And then we also just, because it was the 10-year anniversary of 2008, there were just fears, period, where people just looked back and they said, well, what if that happened again? Mm-hmm. And this combination really turned out to be a little toxic for the last 3 months of the year. People said, well, better to be safe than sorry, and people sold. And so today we're seeing that largely there's nothing to any of these fears. The Fed, as it has been for the 10 years since the 2008 crisis, has always itself been fearful of causing another crisis. And so the moment the markets start to stimulate an early warning system, the Fed starts to pay attention and say, well, largely there is no inflation. Is there really a reason to be in a gigantic hurry to lift rates up and destroy, what is going on, which is largely the confidence of people. So in many ways, 2019 is setting up to be a very, very, very good year. In other words, confidence comes back to the markets. The data and the information confirms the reasons for that confidence. And for our companies, they continue to do what they do best, which is go in and take more market share from the old companies, from the old ways of doing things. And this week in my Bold Profits Daily, I'm focusing on a very unusual disruptification sector, which is pot and cannabis and marijuana, which has an unsavory reputation, and some people think of it as being semi-legal. However, the reality is that people have been working for this sector to be legal, to be treated on the same level and basis as alcohol or cigarettes, which are legal, which actually genuinely have, in many ways, more problems than this sector. And in fact, this week, if you'll have seen in your inbox, we are actually telling you about a stock in our $10 million portfolio service, which is under $5, which we believe could really be a huge stock in the pot, marijuana, and cannabis sector. So something for you to look out for. And also I mentioned it in my Bold Profits Daily tomorrow. So it's really another example of even something like alcohol and wine and cigarettes. Today's world, there is not a single sector that you can look at and say that there is not some new technology, some new way of thinking, some disruptification factor that you can see that can really cause things to really change, where invest in the new and you see huge potential gains and you can see transformation. Invest in the old, and yes, you may get for some short period of time stability in the stock price, and you may even get some dividends. However, you take on permanent risk, which is the possibility of your stock going to zero. So like Ian and Amber are saying, for us, things are really, everything is going in the right direction. For sure, the last 3 months of 2018, that was tough, and that was very tough for us. And if you belong to one of our services, we've given you any number of ways to cope with this volatility. However, things are looking really good, and I'm incredibly optimistic for the stocks in our service and for what's going on. So that's what I have. So back to you, Amber.
Thank you so much, Paul. Excellent update as always. And thank you, Ian, for your insights. And thank you to our listeners for tuning in this week. We look forward to sharing our insights with you again next week. And until, have a wonderful day. Take care.